In terms of growing our business, okay, our small business or small businesses, many a times young entrepreneurs like myself um, invest in a small business. As soon as they see trades of growth, they look for extra capital either through their own revenue or they borrow heavily from banks or financial institutions and invest in that business. Many will tell you that right after investing that heavily into the business, they realize that the business would collapse or something would go wrong and they end up losing everything. I've been there before. For example, there was a company which was producing, or one of my companies was producing fast moving consumer goods. It was a manufacturing firm. We're producing some cleaning, detergents or what you call bleach products. And what happened was that we invested heavily at the beginning because we're getting orders. Within a space of, say, 2 months or so, we're able to sell 7,000 units of the product in just Accra alone or one particular territory, whereas there were so many more territories to conquer. We're getting orders left, right, center. And so we're confident that if we expanded our operations, we could have been able to satisfy the market some more. We took out loans. We put in all of my personal savings, life savings, which I had worked for over 11 or 12 years, put that into the business. And right when we did, a lot of things went wrong at the same time. And by the time we realized, all of our working capital was gone. We had employed too many staff and so on and so forth. Long story short, we lost our operating capital. The business collapsed within 3 years of its operations. So, what lesson did I learn from there? At the end of the day, when you are starting out your path in building a business, you should have a good understanding that of the fact that there are times and seasons in business. The fact that today demand is high doesn't mean tomorrow demand will still be high. Okay? For one of our subsidiaries where we import goods from Asia, US, and UK to sell in the domestic market across West Africa, we had very, very, very high demand for a particular product. We kept importing in small quantities to satisfy that demand. In fact, most of the times, distributors would even send money and pay for goods which had not even arrived. Okay, so they had to wait. There was a lag and all of that for goods. So we thought, why don't we plow back all of the company's revenue and get, expand our operations, import some more so we could satisfy these markets. The moment we did that, it was as if the universe was against us at that point. For those of you who are superstitious, the moment we did that, demand fell and it was a big problem for us. Okay. Now, the difference in those two scenarios, scenario one and scenario two, is that with scenario one, we went beyond the owner's investment capital or owner's capital injection. Okay, so we went beyond just the owner putting in money. We invested the owner's money. We invested the business's own returns, which it had made. And then we went out to even take out loans to reinvest in that business. A business which was less than 2 years at the time. Okay, now with scenario two, what happened was that we reinvested the capital generated by the business itself only, not necessarily the profits generated by the business itself. We didn't make the mistake of reinvesting owner's capital or recapitalizing by the owner or going into the money markets to borrow to come and finance the business. Now, when the two businesses, went down or were affected, it was easier to recover from option B or scenario B than option A. That's a scenario one. Because in scenario one, we had gone beyond our capacity. We had gone ahead of ourselves to include other sources of income or other, sources of funds or capital, which we had to pay back. And so that took us a much longer time to be able to get back on our feet. Okay? Whereas in scenario 2, it was easier to quickly recapitalize or to quickly put ourselves together and, show off what was happening in that scenario. We just had to look for creative ways to discard the goods that we have at discounted prices. We're able to raise some liquidity from there, and then we invested in some area which made us more profitable. Okay, so my main advice to young entrepreneurs out there who want to grow their small businesses is that let the business itself demonstrate to you that it is worthy of your spend. Okay, once you put in that initial capital, do not be in the habit of constantly recapitalizing that business. You should look to win that business off the owner, off the capital markets. Yes, I do know that a lot of businesses have several rounds of fundraising, and that helps them to grow. Okay, but at the end of the day, in my personal experience, what has worked for me and what continues to work for me is to depend on organic growth. You do not have to consistently recapitalize a growing business or a business which has not demonstrated to you that it is worthy of your money. So once you put in that initial investment, make sure that your calibrations are done in such a way that the revenue that is coming in will be able to take care of operational expenses, and also there should be enough for you to save for expansion and growth. At the point of expansion and growth, if some additional capital is needed, because the business would have shown or demonstrated that I can take care of operational expenses, your day-to-day expenses, I can take care of that. The business has also demonstrated to you that on top of this operational expense issue, I would also be able to generate some income which we can save aside for expansion. Then it makes sense to be able to top up or recapitalize in that case. So it isn't every business which is worthy of recapitalization. I think this is one area that a lot of young entrepreneurs make mistakes. Okay, thank you.